This weekend we are watching the opening act of the greatest macroeconomic trap in modern history, and nobody on Bloomberg or CNBC is telling you the real story. While every talking head is focused on the military buildup in the Middle East, the missiles, the naval deployments, the satellite imagery of Iranian installations, they are missing the actual casualty here. The casualty is not going to be counted in geopolitical terms. The casualty is the United States economy. The casualty is your purchasing power. The casualty is the Federal Reserve's credibility. And the guaranteed beneficiary, the only mathematical winner in this scenario, is silver. Specifically, the $133 institutional price target that AuAg Funds published is no longer a speculative forecast. It is now a mathematical certainty driven by what economists call the Stagflation Trap. And if you don't understand what that term means, if you don't understand the mechanics of how this trap works, you are about to get absolutely destroyed by the next 12 months. So let me walk you through this step by step, because this is not a drill, this is not a theory. This is happening in real time as crude oil just spiked to a 6-month high near $66 per barrel on Friday, and we haven't even seen the real move yet. The Strait of Hormuz, which handles approximately 21 million barrels of oil per day, roughly 21% of global petroleum liquids consumption, is now under direct threat. If that choke point closes, if Iran follows through on any meaningful disruption to tanker traffic, crude oil doesn't go to $70. It doesn't go to $80. We are talking about a spike to $100, $120, possibly $140 per barrel within weeks. And when that happens, everything breaks. Not in the way you think, not in the way the media will tell you. It breaks because the Federal Reserve will be forced to choose between two apocalyptic scenarios, and both scenarios end with silver at triple digits. That is the trap. That is the crime scene we are looking at right now. The suits want me to tell you this isn't financial advice. Of course it isn't. It's a survival guide for a burning theater. Do your own research if you still trust the people who stole your purchasing power. But let me be very clear about what I am doing personally. I am rotating capital. I am buying physical silver. I am preparing for a stagflationary decade that is going to make the 1970s look like a warm-up act. And if you think I am exaggerating, if you think this is doom porn, then you fundamentally do not understand the monetary mechanics that are unfolding this weekend. You don't understand what happened in the 70s. You don't understand what just happened with Metropolitan Capital Bank 2 weeks ago. And you definitely don't understand why Jerome Powell is trapped in a corner with no good options left. So, before you click away, before you dismiss this as conspiracy theory, let me ask you a very simple question. Let me know in the comments below, do you think the Fed will choose to save the banking system and let inflation run hot, or will they crash the economy to save the dollar? Because that is the binary choice we are looking at. There is no third option, there is no soft landing, there is no pivot that saves everyone. The trap has already been set, and the only question now is which direction Powell chooses to destroy your wealth. Let me explain the mechanism, because this is where 99% of financial commentators lose the plot. They see oil prices rising, and they think, okay, inflation goes up, the Fed raises rates, problem solved. That was the playbook in the 80s. That was the playbook in the 90s. That playbook is dead. It died in 2008. It was buried in 2020. And it was cremated 2 weeks ago when Metropolitan Capital Bank collapsed in Chicago. Let me walk you through why the old playbook no longer works. Crude oil is spiking right now because of the geopolitical threat to the Strait of Hormuz. This is not a temporary supply disruption. This is not a refinery fire in Texas that gets fixed in 3 weeks. This is a systemic choke point that, if disrupted, sends energy costs vertical across the entire global economy. Higher energy costs mean higher transportation costs. Higher transportation costs mean higher costs for literally every single good and service in the economy. Food, clothing, electronics, construction materials, medical supplies, everything, that is inflation. That is the classic cost-push inflation that ravaged the global economy in the 1970s when OPEC quadrupled oil prices between October 1973 and March 1974. During that period, crude oil went from $3 per barrel to $12 per barrel, a 400% to 100% increase. And what happened to silver? Silver went from $1.93 in 1973 to $50.35 by January 1980. That is a 2,500% return in 7 years. So when I tell you that the AuAg Funds target of $133 is a mathematical certainty, I am not guessing. I am reading the same playbook that already played out 50 years ago. But here is the critical difference between now and the 70s. In the 70s, Paul Volcker could raise interest rates to 20%. He could choke off inflation by making money so expensive that demand collapsed. It was brutal. It caused a recession. Unemployment spiked. But it worked. The system survived. In 2026, Jerome Powell cannot do that. He cannot raise rates. And the reason he can't raise rates is because the entire banking system is sitting on a time bomb of unrealized losses that only gets worse every time rates go up. Let me explain what that means in plain English. When a bank buys a U.S. Treasury bond or a mortgage-backed security, that bond pays a fixed interest rate. Let's say a bank bought a 10-year Treasury in 2021 when rates were at 1%. That bond pays 1% per year. But now, in 2026, new 10-year Treasuries are paying 4.5% because the Fed raised rates aggressively in 2022 and 2023. So if that bank needs to sell that old bond today, nobody is going to pay full price for a bond that only pays 1% when they can buy a new bond that pays 4.5%. The old bond has to sell at a discount. That discount is called an unrealized loss. And right now, U.S. banks are sitting on over $500 to $100 billion in unrealized losses on their bond portfolios, according to the FDIC's most recent quarterly banking profile, $500 billion. That is $500 billion of losses that have not been realized yet because the banks are holding these bonds to maturity and pretending everything is fine. But what happens when depositors start withdrawing money? What happens when a bank needs liquidity? They have to sell those bonds at a loss, and when they sell at a loss, the loss becomes realized. The bank's capital gets wiped out, and if enough banks start realizing those losses at the same time, you get a cascading liquidity crisis. We saw this exact dynamic play out in March of 2023 with Silicon Valley Bank. We saw it again with Signature Bank. We saw it with First Republic. And 2 weeks ago, we saw it with Metropolitan Capital Bank in Chicago. The official story was that Metropolitan failed due to poor risk management and exposure to commercial real estate. The real story is that they were forced to liquidate underwater bonds to meet withdrawal demands, and the losses vaporized their capital base. The FDIC stepped in, seized the bank, and sold the assets to a larger institution at a steep discount. This is the new normal. This is what happens when interest rates go up in a system that is over-leveraged and holding trillions of dollars in low-yielding bonds. So now we come back to the oil shock. Crude just hit $66. If the Strait of Hormuz gets disrupted, crude could hit $100 or higher within weeks. That means gasoline prices spike, diesel prices spike, heating oil prices spike. Inflation, which has been running at around 3% according to the official CPI numbers, could easily spike back to 6, 7, 8% or higher. The traditional Federal Reserve response would be to raise interest rates to cool off demand and bring inflation back down. But if Jerome Powell raises rates, even by 50 basis points, even by 25 basis points, he risks triggering another wave of regional bank failures. Because every time rates go up, those unrealized losses get bigger, the bonds lose more value, the banks get closer to insolvency. And if Powell pushes too hard, if he tries to fight inflation the old-fashioned way, the entire banking system could collapse, not the Big Four. JP Morgan, Bank of America, Citigroup, and Wells Fargo are probably too big to fail. But the regional banks, the community banks, the mid-sized institutions that actually provide credit to small businesses and consumers, they are the ones sitting on the biggest unrealized losses. They are the ones that will go down first. So Powell is trapped. If he raises rates to fight oil-driven inflation, the banks collapse. If he doesn't raise rates, inflation runs hot, real wages collapse, purchasing power evaporates, and the public loses faith in the currency. That is the stagflation trap. High inflation plus economic stagnation plus a Federal Reserve that is completely paralyzed and unable to use its traditional policy tools. This is not a theory. This is not a worst-case scenario. This is the base case. This is what the bond market is already pricing in. If you look at the yield curve right now, the 2-year Treasury is yielding higher than the 10-year Treasury. That is called an inverted yield curve, and it has preceded every single recession in modern history. The market is screaming that a recession is coming. But at the same time, oil is spiking, which means inflation is coming. Recession plus inflation equals stagflation. And stagflation is the single best environment in history for precious metals, especially silver. I spend my weekends analyzing these complex macroeconomic cycles so you don't get blindsided by the Federal Reserve. I am reading FDIC reports. I am tracking crude oil futures. I am monitoring bank balance sheets. I am watching the repo markets. I am doing the work that Bloomberg refuses to do because their advertisers are the same banks that are sitting on these unrealized losses. If this deep dive analysis helps you protect your portfolio, if this breakdown gives you clarity on why silver is about to explode, consider hitting that super thanks button below to support the channel. This is not monetized content. This is not sponsored by any bullion dealer. This is independent research, and it only continues if you support it. Now, let me connect this trap to the $133 silver target, because this is where the math becomes undeniable. The AuAg Funds forecast, which I covered in yesterday's video, is based on a historical analysis of silver's behavior during inflationary crises. But it is not just about inflation. It is specifically about stagflation, high inflation combined with slow or negative economic growth. This is the exact environment we saw in the 1970s, and it is the exact environment we are entering right now. In 1973, the first OPEC oil embargo hit. Crude oil prices quadrupled. Inflation spiked to double digits. The U.S. economy went into recession. Unemployment rose. And the Federal Reserve under Arthur Burns was completely paralyzed. Sound familiar? Burns tried to fight inflation by raising rates, but the economy was too weak. He tried to stimulate the economy by cutting rates, but inflation got worse. He was trapped, and during that entire period, from 1973 to 1980, gold and silver went parabolic. Gold went from $35 per ounce to $850 per ounce. Silver went from under $2 to over $50. Why? Because when the currency is losing value, when the central bank has lost control, when the government is trapped between inflation and recession, hard assets are the only safe haven, not stocks, not bonds, not real estate, physical gold and physical silver. The difference between now and the 70s is that the debt levels are exponentially higher. In 1973, U.S. federal debt was around $470 billion. Today, it is over $35 trillion, 75 times higher. In the 70s, the Fed's balance sheet was around $60 billion. Today, it is over $7 trillion, 116 times higher. The leverage in the system, the amount of debt relative to GDP, the amount of derivatives relative to underlying assets, the amount of rehypothecation in the repo markets, all of it is orders of magnitude larger than it was 50 years ago. That means the potential for a monetary collapse is exponentially greater. And it also means the potential upside for silver is exponentially greater. If silver went to $50 in the 70s when the system was relatively healthy, where does it go now when the system is on the verge of implosion? AuAg Funds says $133. I think that is conservative. I think we could see $200 or higher if this stagflation cycle plays out the way I expect it to. And it is not just AuAg. Other institutional analysts are starting to wake up to this reality. Goldman Sachs recently raised their gold price target to $3,000 to $1,000 per ounce for 2026. Bank of America has a long-term target of $3,500 for gold. If gold is going to 3,000 or higher, and the historical gold to silver ratio is somewhere between 15 to 1 and 50 to 1, then silver at $133 is not only possible, it is likely. At a 15 to 1 ratio, which is closer to the geological ratio of silver to gold in the Earth's crust, $3,000 gold implies $200 silver. At a 50 to 1 ratio, which is closer to the historical average, $3,000 gold implies $60 silver, so 133 is right in the middle of that range. It is not a moonshot prediction. It is a conservative institutional forecast based on historical precedent and current macroeconomic conditions. But the key variable, the thing that guarantees this outcome, is the stagflation trap. If Powell raises rates, banks collapse, credit freezes, the economy crashes, and deflation briefly takes hold before the Fed is forced to print trillions of dollars to backstop the system, which then causes hyperinflation. If Powell cuts rates or holds rates steady, inflation runs hot immediately, real wages collapse, consumer purchasing power evaporates, social unrest increases, and the currency loses credibility. Either path leads to the same destination: massive monetary debasement, loss of confidence in fiat currency, and a flight to hard assets. Gold and silver are the only assets that have maintained their purchasing power over centuries. They are the only assets that central banks cannot print. They are the only assets that do not carry counterparty risk. When the banking system is insolvent, when the government is insolvent, when the currency is losing value, physical precious metals are the ultimate safe haven. And let me be very clear about what is happening in the physical silver market right now, because the price you see on the COMEX is not the price you pay at your local dealer. There is a growing disconnect between paper silver and physical silver. The spot price on the COMEX, which is the price that gets reported in the financial media, is currently around $29 per ounce. But if you walk into a bullion dealer today and try to buy American Silver Eagles, you are paying anywhere from $4 to $7 over spot. That is a premium of 15 to 25%. Why? Because there is a shortage of physical product. The mints cannot keep up with demand. Dealers are running low on inventory. Delivery times are extending. And the people who are buying are not flippers, they are not traders. They are long-term holders who understand that the monetary system is broken and they need to get their wealth out of the digital banking system and into physical assets that they can control. This is the same dynamic we saw in March of 2020 when the COMEX price of silver briefly crashed to $11 per ounce, but you could not buy physical silver anywhere for less than $20. The paper price and the physical price completely decoupled. And if we get another banking crisis, If we get another liquidity event, if the Fed is forced to choose between letting banks fail or printing trillions of dollars, that decoupling is going to get much worse. We could see a situation where COMEX silver is trading at $40, but you cannot buy a silver eagle for less than $60 or $70, and at that point the COMEX price becomes irrelevant. The real price is whatever the physical market is clearing at, and the physical market is telling you right now that silver is undervalued and undersupplied. I am watching the crude oil markets and the banking sector like a hawk this weekend. If we see another bank drop, if we see oil gap up on Sunday night when futures markets reopen, if we see any escalation in the Middle East that threatens the Strait of Hormuz, I will issue an emergency alert. Make sure you are subscribed to the channel with the bell notification turned on so you don't miss it. Because this situation is evolving in real time, and the window to position yourself before the crowd figures this out is closing rapidly. When the mainstream media finally starts talking about the stagflation trap, when Bloomberg finally admits that the Fed is paralyzed, when CNBC finally acknowledges that the banking system is insolvent, it will be too late. The premiums on physical silver will be so high that most people will not be able to afford it. The dealers will be sold out, the mints will have months-long waiting lists, and the price will already be in triple digits. Let me give you 3 historical examples of how fast this can happen. In 1979, silver was trading at around $6 per ounce in January. By January of 1980, it was over $50. That is an 8 to 100% gain in 12 months. In 2010, silver was trading at around $18 in August. By April of 2011, it was over $48. That is a 160% gain in 8 months. In 2020, silver was trading at around $12 in March. By August of 2020, it was over $28. That is a 130% gain in 5 months. Notice the pattern. Every time there is a major monetary crisis, every time the Fed is forced to print money or cut rates aggressively, silver moves fast. It does not give you weeks or months to position. It moves in days and weeks. And by the time the general public figures out what is happening, the move is already halfway over. This weekend, we are on the verge of the next move. The oil shock is the trigger, the banking crisis is the accelerant, the stagflation trap is the mechanism, and the $133 target is the destination. You can choose to ignore this. You can choose to trust the Federal Reserve. You can choose to believe that Jerome Powell has some secret tool that will save the economy without destroying the currency. Or you can look at the data. You can look at the history. You can look at the bond market. You can look at the oil market. You can look at the banking sector. And you can make the rational decision to protect your wealth by converting paper dollars into physical silver while you still can. I am rotating my capital out of the fiat system and heavily into physical silver to survive this stagflation trap. I am not waiting for confirmation. I am not waiting for the media to tell me it is okay. I am not waiting for the Fed to admit they are trapped. I am acting now because I understand the mechanics of what is happening, and I understand that the window to act is measured in weeks, not months. If you want to see exactly how I am allocating my portfolio to prepare for Monday, if you want access to the specific strategies I am using to navigate this crisis, if you want real-time updates as this situation unfolds, click the Join button and become an Insider member today. I am publishing detailed portfolio breakdowns, I am sharing live trade alerts, I am hosting members-only Q&A sessions where we go deep on the technical aspects of the stagflation trade. This is not generic financial advice, this is not surface-level analysis. This is the real work, the kind of work that separates the people who see the crisis coming from the people who get blindsided by it. And let me address the skeptics for a moment, because I know some of you are thinking this is fear-mongering. You are thinking oil has spiked before and nothing happened. You are thinking the Fed has gotten out of tight spots before. You are thinking the system is too big to fail. Let me walk you through why this time is different. In 2008, when the financial system was on the verge of collapse, the Fed had room to cut rates. The federal funds rate was at 5.25% in September of 2007. By December of 2008, it was at 0. The Fed cut rates by 5.25% in 15 months. That rate cut, combined with quantitative easing, saved the system. In March of 2020, when COVID hit and the economy shut down, the Fed again had room to cut rates. The federal funds rate was at 1.58% in March of 2020. By March 15th of 2020, it was at 0. The Fed cut rates by 1.58% in 2 weeks. That rate cut, combined with $5 trillion in fiscal stimulus and money printing, saved the system. But now, in February of 2026, the federal funds rate is at 4.33%. If the Fed cuts rates to 0 again, they buy themselves maybe 12 to 18 months before inflation spirals out of control. And they have already done that twice in the last 18 years. The market knows the playbook. The market knows that rate cuts equal currency debasement. The market knows that quantitative easing equals inflation. So the second Powell starts cutting rates or announces QE, the dollar gets sold, commodities rally, and inflation expectations spike. The Fed has lost the element of surprise, they have lost credibility, and they have lost the ability to use monetary policy without triggering a currency crisis. At the same time, if Powell tries to hold rates steady or raise rates to fight the oil-driven inflation, he triggers a banking crisis and a credit crunch. Small businesses cannot get loans. Consumers cannot refinance their mortgages. Regional banks start failing. Commercial real estate implodes. Unemployment spikes, and the economy goes into a deep recession. So you have inflation on one side and deflation on the other side, and the Fed is trapped in the middle with no good options. That is stagflation. That is the 70s playbook. And that is why silver is the only rational hedge. Gold is great. I own gold. But silver has more upside because it is more volatile, it is more undervalued relative to gold, and it has industrial demand on top of monetary demand. Silver is used in solar panels, electric vehicles, electronics, medical devices, water purification systems. If the global economy continues to transition toward green energy, which every major government is pushing, demand for silver is going to skyrocket. The Silver Institute estimates that industrial demand for silver will increase by 25% over the next 5 years. At the same time, silver mine production is flat or declining. Most silver is produced as a byproduct of copper, lead, and zinc mining, and those mines are not expanding fast enough to meet demand. So you have increasing demand, flat or declining supply, and a monetary crisis that is driving investment demand to record levels. That is a perfect storm for a massive price spike. And here is the kicker. If the COMEX runs out of physical silver, if the paper market loses credibility, if investors start demanding delivery instead of holding paper contracts, the entire price discovery mechanism breaks. The COMEX has roughly 300 million ounces of silver in registered inventory. That sounds like a lot until you realize that global investment demand alone is around 200 million ounces per year. If even a small percentage of paper contract holders demand physical delivery, the COMEX does not have enough silver to meet demand. They would have to declare force majeure, suspend deliveries, and settle contracts in cash. And the second that happens, the trust in paper silver evaporates, and the price of physical silver goes vertical. This is not a hypothetical. This almost happened in March of 2020 when the spread between physical and paper silver exploded. It almost happened again in early 2021 during the Reddit silver squeeze. And it could happen again in 2026 if the oil crisis triggers a banking crisis and a flight to physical assets. So when I tell you that $133 silver is a mathematical certainty, I am not guessing. I am not hoping. I am reading the macro data, the supply and demand fundamentals, the historical precedents, the geopolitical risks, and the central bank policy constraints, and I am coming to the only logical conclusion. Silver is going higher, much higher, and the people who position now, before the crowd figures it out, are going to make generational wealth. The people who wait, who sit on the sidelines, who trust the Fed to fix this, are going to watch their purchasing power evaporate as inflation runs hot and the currency loses value. This is not a game. This is not entertainment. This is your financial survival, and the clock is ticking. The oil shock is happening this weekend. The banking stress is already visible. The stagflation trap is set, and the only question left is whether you are going to act or whether you are going to be another casualty of a system that has been rigged against you from the start. I have made my choice. I am all in on physical silver, and I am not looking back.